At IBCanada Group, we are your complete and independent source on the infinite banking concept, serving Canadians from coast to coast.
Hello, I'm Steve Maclellan, the financial engineer and proud member of the IBCanada Group, where we are independent advisors from coast to coast to coast, where we help you grow, control, and keep what you build instead of giving away to taxes, fees, and the unknown. And we are represented very well here today. We got Wayne from Saskatoon, Glenn from Calgary, and Scott from Toronto. How are you guys doing?
Doing well. Pretty good.
I'm here from Halifax, and we're going to be talking about the best way to purchase a vehicle. I guess in Glenn and Wayne's circumstances, it'd be the best way to buy a truck. But let's get to her. You know, I look back at the ways. Well, I was in Calgary when I bought my first truck, and I looked at all these different ways, you know, and don't hate me because I bought brand new. I know buying brand new is not the best financial decision out there, but hey, I was in my mid-30s. It was my first vehicle, newly pregnant, not me. My wife was pregnant. And I bought a nice F-150, and I did all the math. I did all the spreadsheets, and I came up with a way, but what I did not take into account was the opportunity cost that I lost. So Wayne, you know, in Saskatoon, does this come across your desk very often, or do many people ask you what is the best way to buy a vehicle? Or in your experience, let's start off with the worst way to buy a vehicle.
Yeah, so I think people have become so accustomed to doing what they've been doing traditionally that they aren't maybe even asking questions, but I like to provoke my clients to think. And so part of what I want to say is, what is the worst way to buy a vehicle? And I think the worst way to buy a vehicle is to debt finance it when you don't have the capacity to actually save up the money and have any options. And so you get in the debt cycle, you put yourself into a lifetime of debt cycle, and you die in a debt cycle. And there's virtually no way to get out of that unless you have a plan. And the plan would require you to have discipline to begin to store up and save up. And then once you do that, then you can ask better questions. Once you have some cash or capital saved up, you now start to say, what are the other options? And so I think when people start to look at the options and do the math, they discover very quickly that there are a number of ways for them to think differently than the traditional financing mechanisms or the media's solution to their problem.
Now, you talked about the worst way to buy a vehicle, and looking back, maybe I did end up doing the worst way. It was a great way on math, but I ended up using cash. But can you explain what the best way to buy your vehicle is?
So I think when people start thinking about economics or finance, they need to get definitions in their world. And so we need to understand that cash and capital are not synonymous. Capital has an acquisitive component to it. Capital will reproduce every single day of your life with every beat of your heart, as Scott says, if you don't screw it up. And so once you understand that, you're going to preserve and protect your capital with your life, and it's going to work for you for the rest of your life. So why would you take an appreciating asset like capital and exchange it for a depreciating asset like a vehicle? So that to me is a fundamental question people need to wrestle with, and then they need to discover the answer. So if I don't use my own capital, whose capital am I going to use? How am I going to acquire the vehicle? And I'm saying, if you have the capital, if you've had the discipline to save the capital, for goodness sakes, don't give it up. Use other people's money. And it really doesn't matter if you have to pay a higher interest rate. Interest rates become a distraction. And again, that's a statement that really troubles people because we've been programmed to focus on the rate of interest rather than the volume of interest. And so the best way to buy a vehicle is to save up your capital, then leverage your capital to borrow somebody else's money, be glad to pay them an interest rate, as the banks are, while your money is reproducing every day and you're paying down your debt. You've got a spread called opportunity cost, and it's going to serve you well for the rest of your life.
So this isn't a discussion about financing versus buying right out. You're saying using capital. Now, I think everybody knows what cash is. Can you explain a little bit what you mean by capital?
So the difference between cash and capital is that capital has this acquisitive component to it. If you steward capital well, it will grow every single day or with every beat of your heart. So once that's happening, why would you ever give your capital away? You're not going to. You're going to preserve it and protect it, and it's going to grow and grow and grow and multiply. Part of our challenge is we don't look down the road far enough. If you're 30 years old buying a truck in Calgary for 30 grand or 50 or 90 or 120, you need to start thinking what's going to happen over the course of my life, which might be another 40 or 50 years. And all of a sudden, you begin to discover that tinkering with your capital, this incredible asset that will serve you well, is a really, really bad idea.
There's something the majority of Canadians don't look at. Now, Glenn, I mentioned the not taking into account the opportunity cost when I was looking at buying my vehicle, and Glenn and Wayne mentioned, using your capital and that disappearing. Why is it so important to recapture that opportunity cost that we miss out, or retaining your capital, as Wayne said, probably even more eloquently?
Steve, when you're talking about opportunity cost, it's just that. If you've given up your capital, then when an opportunity comes, boy, it's going to cost you because you're missing out on it, right? So building up that capital, as Wayne said, once you built it up, if you understand how it works, you'll never ever let it go, right? So having that storehouse of capital and using other means, other people's monies to finance the different things in life gives you that storehouse that when these opportunities come up, you can still take advantage of them. So rather than doing just one thing with your money, it gives you the opportunity to have duplication. You can do more than one thing with the same capital if you're using other people's cash to, for example, finance a vehicle.
Awesome. So when we're talking about growing, controlling, and keeping your money, we're talking about being able to buy things like a vehicle, but still have that capital where it's growing for you in the long run. Scott, maybe you're very eloquent at explaining this and the mindset that is needed, because this is a big deal. Very, very few people follow this process. But why should more people actually pay attention to this, especially when buying large purchases such as a vehicle or maybe even large investments down the road?
It comes back to the lost opportunity cost. Once that money is transferred out of your system, you are no longer able to make any sort of money from that capital that you've transferred away. That's the lost opportunity cost. So one vehicle transaction at $30,000, $40,000, $50,000 is now money taken away from your ability to compound that towards your financial future. So it's no longer $30,000, $40,000, $50,000, but it could be hundreds of thousands of dollars that's not going to be there when you cross the retirement finish line. Infinite banking allows you to capitalize, become the banker. And if we go back to the financing aspect, if I go and borrow money from a lender, they have already done what every individual should do. They have pre-capitalized a financial system on their own that allows them to be the lender. And we now borrow from them and pay them the interest. Well, if we didn't save the money in the first place, where was the money to come up with the debt? Suddenly, as soon as we incur debt, we change where our money goes. So we have the money to pay for that car. The money was already there. So we can get people to now start to think from a business perspective. Instead of being spenders, they can now become savers. And they can capitalize a banking system where they can now borrow from themselves and become and duplicate the same process that the banks and the auto financing companies are doing. They understand lost opportunity cost. They want that money to continually grow.
This is something I wish I knew. So I bought my vehicle close to 10 years ago. I bought it when my wife became pregnant. It was my first vehicle and very proud. And I know you're not supposed to buy a brand new vehicle, but I got myself, Glenn, I was in your neck of the woods, Calgary, Alberta. I got myself an F-150. And anyways, very proud of it, but that's exactly what I did. I ended up using cash. It was 50 grand. And that money just disappeared from me. It went from me to the car dealership, no matter what. And then they did whatever they did with it. But using this process, the infinite banking concept, to become your own banker, you can actually have that capital inside. The best way we look at it, right, is as a properly structured dividend paying whole life policy, and have that capital grow for you while you can still purchase that vehicle and pay yourself back. Do you agree with what I just said there, Wayne? Is that a good?
Yeah, I think that's exactly what you need to you need to be thinking about, is that your 50 grand that you gave to that car dealer, you gave your capital to somebody else's system, and they're going to benefit from your capital. The problem is, if you haven't done the math, you don't understand what that actually means, and so it doesn't trouble you. But Steve, you're a younger guy. When you bought that truck, you've got a whole lifetime of earning, and even at 5%, that 50,000 would multiply several times, and you probably lost, I'm going to guess, 250,000 or more that the car dealer actually benefited, and you have a truck that's now wore out. And I'm going, it doesn't make any sense, but boy, is it common.
Yeah, sometimes I wish I could just stick my head in the ground and not know what I didn't know back then. But the difference is I do know now things we know. And that's the whole idea. We're trying to share what we know to those that want to be able to keep their money and make it work harder for them, instead of just giving it away to the banks or, taxes, fees, but actually give it to those that they love. And it's my belief, if we have more control over our money, we're just going to have bigger and better communities and spend more time on what's truly important. Now, excuse me for getting off on a tangent. I got a little bit of passion with this, and you hit a nerve, because I now know how much that truck actually costs. So, Wayne, talk about this a little bit more. You're the king of capital versus cash. Kind of dive a little deeper on how to get set up so you can take advantage of what you now know.
So I love to say to my clients when they say, Wayne, I'd like to come talk to you about investment. I say, great. And then I ask them, do you want this cash to grow, or do you want to turn it into capital? Do you want to convert it to capital? And they don't know what that means. So once we have that conversation and they begin to understand capital, and one of the statements I love is this: once you see it, you cannot unsee it. Once you understand it, you cannot ignore it. And so once people get that, then I say, okay, before we start investing, why don't we think about putting your money, if you're going to keep it forever and ever and ever, your capital, why don't we store it inside a structure that you actually have absolute control and access to? And so now we have to start talking about a vehicle, and then we have to start talking about a process, and then we get this discipline going, and pretty soon people realize, wow, I've never heard this. The traditional system, the education system, society doesn't ever talk about this. And I'm going, that's largely because people don't understand, because they haven't taken the time to think. Thomas Edison once said, 5% of people think, 10% of people think that they think, and 85% of people would rather die than think. And it's tough to work with the 85%. It's not very much fun working with the 10%. But boy, when you can find that 5% that actually want to understand and take control of their wealth creating systems, boy, there's a lot of different ways. So I work with my clients to say, first of all, let's figure out capital. Let's not become distracted by rates of interest, but rather volume of interest. And then let's start to think about our options, and let's just do the math. And once we do the math and people start to understand that, they will never again give up capital for a depreciating asset.
Well said. Now, Glenn, we that's how the masses would buy a vehicle. We talked about that. But what about business owners, or those that make their vehicles a business expense? Does that change anything that we've been talking about?
Well, as far as changing things, I guess depending on how you're going to be using the vehicle, yes, it can. Now, when it comes down to how you pay for that, then things could be more similar than not, right? Because at the end of the day, and I think business owners are a little bit more key to understanding this once it's been explained to them. If you can hang on to your capital and use other people's money, I think most business owners don't need their arms twisted too much.
Here. Now, Scott, I see a couple of books behind you. And I know there's a great example in the Become Your Own Banker by Nelson Nash. But where can people find more information on what we're talking about, using the infinite banking concept to buy mainly big purchase items, but such as vehicles, but also as investments, other ways?
That would be go to the internet, absorb as much information as possible. Obviously, contact any one of us, go to our social media and YouTube channels. The best way to understand infinite banking is understanding the benefit of it. The problem is, if we do not know that we have a problem, we are never going to search for the solution. So by understanding the problem in the first place, and as we've all talked about, it's the lost opportunity costs. It's cutting down that apple tree and stopping the growth of that tree over time and replacing it every single year. We interrupt the compounding of our money. So it's these videos, it's educating the public that the way we've been taught to deal with money benefits nobody but those who receive the money in the first place. And we now have to be the depository of our own capital and keep it into a system where there is no leakage and our money will just consistently grow and grow and grow. And this is one of the biggest problems with the whole industry, is that we are fixated on saving 10% of our money and flushing the other 90% down the toilet.
This really reverses that, where you get to
It does.
keep 90%. Yeah, it's a game changer when you, Glenn, I know you're a master of the money mindset and changing things. What's the biggest hurdle for people to look at this process of buying a vehicle?
Steve, as both Scott and Wayne have said, it's mindset. It's what we become accustomed to. It's what seems to have worked. Why in the world would you change it with something that requires me to think differently, right? So until more and more people we start getting to more and more people to say, look, you hold on to this asset. You use this asset as leverage to get the other things in life you want while this asset keeps growing. Now, you can be in the position to do that, or you can just keep on making somebody else rich by doing the traditional thing. Your choice. And if they're just not ready for it, they're not ready for it. But for those who are, who we connect with, when you see that light bulb go on and they realize that, hey, I can do this, as Wayne says, hold on to this capital for the rest of my life, this growing pool of capital that stays tax-free and that will eventually be passed on tax-free to my beneficiaries. But I get access of it during my lifetime to direct in ways to make the purchases I would normally make and continue to enrich myself as opposed to my traditional institutions. Whew. When that hits, it's a beautiful thing to see. Right? I love guiding people to figure that out.
It is. Once you, as Wayne said, once you see it, you can't unsee it. And sometimes there's part of me that wish I could unsee that, because I did all the calculations. I did the engineering thing. You should have seen beautiful spreadsheet. But now, knowing what I know, that one vehicle, I lost probably, like you said, Wayne, close to $250,000, and that's just one vehicle. And how many vehicles does a person generally buy in their lifetime? Sadly, it's not just one, right? So this has that compounding effect. Wayne, any final words, or really to make sure that this hits home? Because this is, again, once you see it, you can't unsee it. But I'm just going to give you some final words there.
Yeah, so I think, the challenge is what I call delayed gratification. You're either going to have the discipline to prepare on the front end, or you're going to have the misfortune of paying right through to the back end. So I think I say to my clients often, my optimal client is 21 inches long. They've yet to make any bad decisions, and I can build them a pool of capital that by the time they turn 20, the pool's been built. Now I just have to teach them the discipline to use it. But it's difficult to get people to delay their gratification long enough to build a capitalized system that can advantage them forever. And we just have to learn to control our appetites a little bit better.
Glenn, how about you? Any final words?
Well said, Wayne. Well said. You know, at the end of the day, as we talked about, Wayne talked about his ideal client being 21 inches. And why that's so profound is because we're talking capital and lifetime assets. So the longer runway you have, the more powerful these tools become over that lifetime, right? So that's what excites us. I mean, those of us who are parents or grandparents, or those of us who are just hoping we're going to be around for another good chunk of life. The longer we're around, because of this discipline to build this, the more fruitful and the more opportunities it's going to yield going forward. So it's an exciting thing for me, and I know for you guys as well, and for those clients who we actually get to start thinking differently.
Awesome. And Scott?
Yeah, so everybody should get a copy of this book. You can connect with us to get a copy. You can order from Amazon or directly from the infinitebanking.org site. And Nelson Nash, the creator of the infinite banking concept, has three really important things that will resonate with this video. The first one is infinite banking is caught, it's not taught. You have to understand the problem before the solution makes any sense. Secondly, we finance everything we buy. We either go into debt and pay interest to somebody, or if we've saved up our money and we transfer it away, we give up the ability to earn interest on that money. So there is no free lunch. There's just one opportunity to recapture all of the lost interest cost, and that's with infinite banking. And the third one is that there's only one pool of money, and we are trained essentially from 21 inches long to transfer that pool of money that we have into a bank. And once it's in the bank, they control the whole process. We got to get people to understand the problem and to have that money transferred into their own privatized bank where they get to recapture everything. And we've looked at this as, for car financing. A car finance is an expense. The beautiful thing about infinite banking is that we can convert those expenses into an asset that will continue to grow, not during your lifetime, but your children's lifetime, your children's children's lifetime. It never leaves your bloodline. And that is a very important legacy, cascading legacy opportunity that every Canadian has the ability to create for themselves.
Who would have thought a discussion on the best way to buy a vehicle would have just mind blown, right? If you're watching this, we talked about opportunity cost. We talked about capital, using your capital versus cash, or more or less keeping your capital. And just the act of buying a vehicle, how can really derail your financial independence. But there is a way to do it where you can maintain and keep your financial independence. And as everyone on this call mentioned, passing it on to the next generation. Guys, I wish I knew this 12 years ago, 10 years ago. And it's our goal there to get this information out. If you are watching this and you got some value, please share this video with those that you care about. Give a big thumbs up and reach out to a member. As you can see, we're well represented here today. We have memberships all across Canada. All you have to do is go to our website, IBCanadagroup.ca.com works as well, and reach out to an independent advisor near you. And they're going to show you this concept so you can grow, control, and keep what you build instead of giving away to taxes, fees, the unknown, and as we mentioned, that opportunity cost. Appreciate you fellas. Always learn a ton when I'm talking to you, and proud to be a member of the IBCanada Group with you.
IBCanada Group, your independent authority for information on the infinite banking concept.